William O'Neill, India. Very good morning to you, Mayuresh. Great to have you with us, as is always. Season's greetings to you. Talk to us about, what do you make of the market momentum in the last two trading sessions, and, what do you foresee in the, week to follow, which is going to be a truncated week as well, because we've seen a dip and we've seen a smart recovery. What is the conviction like? Are we going to see a sea of recovery now, or are we going to see some more dwindling now?
Morning, Sakshi. Morning, Shel sir. Morning, Kiran. Season's greetings to you, Sakshi, Shel sir, Kiran as well. Hope this year brings a lot of joy, wealth, prosperity and happiness to all of you and all the viewers of Business Today. Having said that, the profit booking, as I would term it, that we probably saw a couple of days back was warranted in the markets. Markets had run ahead of themselves, specifically the broader markets, and therefore the correction that came through for that day was a welcome sign. I think that correction is very well needed to remove the froth that starts building up in the market. Having said that, is there a structural downside for the market from what we've seen on that day of the fall a couple of days back? I don't think so, because in a bull market, which we've also seen in the past, such intermittent sharp corrections keep on coming through. In fact, to a certain extent, we have also seen after a huge rally that markets might also correct to the extent of 5, 10, 12%. I'm not saying that we will at this juncture, but I think that's always a sign of a bull market where these sharp corrections come through, and the recovery is equally sharp. You saw that yesterday, where there is a sharp recovery in the broader markets. And needless to say, I think the Indian macros and micros are holding up. So I'm not revert to that point again. I've had news since morning about that point. Where the markets will be next week, obviously I think with FIs out of action, it's going to be a lot of DI stroke HNI stroke retail participation and a one-sided participation that is in the coming week. So I expect, I think, the exuberance to probably continue for equity markets. Global cues have been supportive. And obviously as we head into the new year, earnings on how Q3 will play out, and obviously a play to the budget, the interim budget which will be announced, are a few triggers which will probably be playing out on the markets. And obviously I think the pre-election rally and delivery. So I think the market structurally looks very, very positive even now.
Okay, the markets look structurally positive even now, and that should give a little calmness to all the nerves that are floating around as far as the market investors are concerned. What about the two stock picks that you would be sharing with us today?
Sure. So I think the areas that we are looking at continue to be the same. It's infra, apex, manufacturing as one theme. We've obviously got very selective in terms of mid-cap IT, in terms of what commentary has come out from the Fed, and selectively bullish on auto ancillaries and capital equipment. Having said that, within the mid-cap IT space, FirstSource Solutions is something that we like at MarketSmith India. The numbers have been pretty encouraging in the first half. There has been a steady constant currency growth, and the management for FY24 expects a 1 to 2% constant currency growth. On the EBIT front, because EBIT margins actually are very important on how the operating efficiencies of IT companies are probably looked at. For the first half, they've done 11.2%. For the expectations for FY24 are between 11.2 and 11.5. So there is a steady increase that can get expected. In the previous quarter, the deal wins were one of the highest that FirstSource reported. From a geographical mix, US is one of the largest geographical areas. And again, within the product suite that they probably got, the expectations in terms of ramping up their existing portfolio and the product that they've got specifically related to generative, automotive or artificial intelligence, they call it as Gen AI. I think there is a huge scope that probably comes through, both in terms of existing corporates, most enterprises in US and Europe that probably want these investments to probably come through. And therefore, the proprietary framework that they're probably building in, they've called it FirstSense.ai. They've already got almost 100 plus cases across industries that they're doing, and they're getting a huge response. And we'll get it from the management transcript and a few calls that you've probably attended as well. So FirstSource, even from a dividend perspective, almost 2% dividend yield, expectations of reasonable growth and operating leverage will be played out. So this is one stock that can definitely be kept on the radar. The other one I'll continue with Exide. My sense is that with the kind of expectations that one has, we are hearing of the FAME 2 policy being extended. And a lot of these lithium-ion battery makers are going to benefit quite significantly. They've already started establishing a capacity of 6 gigawatt hours with an outlay of 600 odd crores. Their peers, Amara Raja batteries, are also doing the same. So I think they are the only two listed players within the Indian ecosystem which will probably provide batteries at such a large scale in the next few quarters. And as that entire ecosystem goes through this dynamic process, the process in terms of providing existing batteries to the petrol diesel cars, the internal combustion engines as we call it, the replacement market holding up, the industrial part of the market which is expected to largely hold up with better margins and pricing and reasonable amount of balance sheet with absolutely no leverage makes a very solid case for Exide to probably start giving fabulous numbers over the next few quarters, to say the least. So I think an absolute proxy on the entire electric mobility theme. And again, one of the two players will probably provide batteries on such a large scale. I think FirstSource, and I continue with last week's call.
Okay. Very good morning to you, Mayuresh, and season's greetings from our side to everybody at home, to you, and of course the entire family of William O'Neill Securities. Like I said, I have added FSL and Exide batteries against your name in the grey book that I maintain for 22nd December. I can remind you of the previous talks that you've talked about. On December 8th, you mentioned Welspun Enterprises, Bikaji and Voltamp. And on December 12th, you mentioned L&T, Maruti, Texrail, Ace Equipment and Sangvi Movers. So, as I said, this black book is very, very precious to me. It also helps me keep track of all good fundamental counters. And I keep reminding our guests that this is the one that you had recommended on this particular day. So today's entry is FirstSource Solutions at 183 and of course Exide at about 308. Exide of course is at a record high and this is something that needs to be watched. Mayuresh, when you look at the granularity of yesterday's rise, it was led by HDFC Bank and Reliance from the very start. From the first 1 minute of trade, you saw both these two stocks in the green, and that added to a lot of confidence and a lot of sanity to the market. Your views on HDFC Bank at current levels?
So you're absolutely right. I think out of the large caps, HDFC Bank, Reliance have hardly delivered any sort of absolute returns in a year's time frame. And if you look at the broader market construct and how these large caps are placed over the next year or couple of years, A, from a valuation perspective, looking very, very attractive. B, even from an entry perspective, because they have hardly done anything for the past 1 year, looks attractively placed and poised as well. Now, the presumption here is that FIs will come back with their own, not just in the first half of the next calendar year, but significantly in the second half as the rate cycle begins in the US. These large behemoths should start delivering, not just in terms of the flows, but even in terms of numbers on the pace that they're working at. Expectations largely for HDFC Bank, a very reasonable amount of deposit growth that they have built up. Obviously, the merger dynamics that will play out will hit NIMs to a certain extent. But with the rate cut cycle, which will get initiated in India as well in the second half of the next calendar year, with all the probabilities working in the favor of a reasonable amount of cut happening in the US followed by the Indian markets, the Indian ecosystem, as far as the NIM spreads are concerned, should largely improve. The second element, obviously, is the mix that they'll probably have in terms of whole loan advances. The kind of advances that they give in terms of risk-weighted assets are largely monitored in terms of both their GNP and NPAs control in a very reasonable fashion. Therefore, coming off would also mean significant amount of growth as far as balance sheet and return ratios are concerned. So I think this is one stock along with Reliance that we definitely have on our watch list as far as large caps are concerned.
Mayuresh, to you on the railway pack, today RailTel has announced that the company has won a 66 crore rupees order from Northeast Frontier Railway Construction. Yesterday it was Texmaco Rail, before that it was RVNL again. What's really happening here is flurry of orders flows coming in. How would you look at this entire pack and your top stocks from this space?
So as we discussed earlier, Sakshi, I think the structural story continues because the kind of order wins that are coming through are still expected to come through in the next few quarters. Albeit, I think in the next couple of quarters, because of general elections, the order wins will be a little bit muted. But post that, I think the kind of capital expenditure that is expected from the railways, the announcements that have been done for new lines, new coaches, new wagons are obviously going to aid many companies in this sector. The second element obviously is the kind of margins that these orders are coming through. And because execution is improved, there are strict timelines to execute these orders as well. The operating leverage gets played out on the balance sheet, and the receivable days are far lesser because of the payments that are coming through on time from the only source that they've got, the government, which is both the center and the state. Having said that, I think stocks like Texmac Rail, which Shell sir has written in his diary as well, a week back. If it pulls back, I think it becomes a very attractive proposition because apart from freight wagons, they're also probably looking at passenger wagons in the near future, expanding capacities. Balance sheet looks out to be a very good turnaround story from what they were a couple of years back. And therefore, any pullback probably looks like a very reasonable case here. And same is the case with IRCTC. I think that stock has hardly done anything. What they are probably expected to deliver in terms of numbers can be relatively better in the next few quarters. So any pullback on IRCTC is also something that investors can probably look at. And obviously the foray that they're probably doing outside the domains that they're working out gives them a huge market opportunity, which can be very well taken in their stride as far as margins are concerned, as well as overall growth for the bottom line, which obviously will get reflected in terms of the return ratios. So I think both these stories with the railway stocks on pullbacks might be attractive propositions.
Okay. Right.
Okay. Sakshi, let's mark some more prices. Please go ahead. Please go ahead.
Yes, Shell, I just wanted to ask Mayuresh one more stuff. We were discussing about the frontline banking stocks. Recently, the RBI has tightened the norms for investing in AIFs as well. Help us understand if you've understood, what the impact of this could be on the NBFCs, because they are now preventing them from evergreening rules as well. What would this impact, lead to?
So I think there are two aspects here, and we've already heard announcements actually from both Piramal and IFL as far as their investments in AIFs are concerned, and the kind of provisioning that might be required. Because what the RBI circular says is you either liquidate those assets within 30 days or you provide completely for the assets that you've probably taken positions for. So I think liquidation in 30 days is an impossible task. So provisioning is something that will be required, which obviously has two impacts. One, I think the net worth of your of the company probably gets hit quite significantly. And secondly, I think with the kind of provisioning that is done on the balance sheet itself, your capital adequacy starts taking a hit. And because of that, with the erstwhile circular as well for unsecured loans, personal loans, where already there is going to be a shave off in terms of CET1 ratios, that will impact or hamper to a certain extent the kind of advances growth that one probably looks at. So yes, I think the NBFCs which are probably affected by that will probably feel the pinch, both from a book value perspective, which will obviously get eroded, and obviously from a balance sheet expansion perspective because of this circular, because it will create a dent in terms of elevated provisioning and a hit in terms of the CET1 ratios.
Mayuresh, yesterday a news came that Bharat Electronics Limited has actually upped its order flow guidance to 25,000 crores from 20,000 crores earlier. How do you see this stock and what are your expectations?
No, so anybody holding on should continue. I think the positive momentum will continue as far as numbers are concerned. I was hearing the management out yesterday as well. And that's a significant accretion in terms of the order book wins that they have, which gives us significant revenue visibility over the next few years. Again, they're very, very confident in terms of maintaining the margins on that overall order book that they've got between 21 and 23%. And therefore, as that execution process picks up even more steam going forward, the kind of revenue growth which is expected in double digits, margins which are expected to be steady state between 21 and 23% means a reasonable amount of profitable growth expectations, and as far as the EPS is concerned, a reasonable growth over the next 2 years. So anybody holding on to stock should continue holding. I think it's a reasonable amount of growth that this company can deliver.
Mayuresh, the bellwether IT firms, and how would you treat them now?
I think the sector has done reasonably well, and our belief is that large caps obviously are trading at a reasonable valuation compared to mid caps. But I think there will be some element of pain as far as numbers are concerned, even for Q3, because if you go by commentaries, that pain might very well persist in a quarter which is particularly weak, which has a lot of furloughs, Christmas holidays, so on and so forth. So valuations cheap, but I will still wait out for quarter numbers for the large caps IT stocks. Within mid caps, as I said, a lot of stocks have given very positive commentaries. No expectations in terms of either pricing issues, no expectations in terms of any deterioration as far as EBIT margins are concerned. Valuations obviously are at a premium compared to large caps, and that gap has obviously widened. So anybody holding on can obviously ride the momentum, but a couple of stocks, as we have been discussing, FirstSource Solutions and Cyient is something that we continue liking at MarketSmith India.
All cargo logistics is moving higher very, very strongly. 7.7% higher. It's now the top mover in the Nifty 500 basket. Do you have a view in the logistics space, Mayuresh, if you can share with us? You're also seeing some of the other stocks buzz off late, like, Blue Dart, Delivery. They've been moving up in trade as well. Of course, there's a news flow for all cargo today that's triggered this move. But how do you assess this entire space, subsector?
I think it should do well, and as a space, I think if you're probably looking at 3PL, 4PL, the different arms within the logistics space expected to continue doing well. The expectations in terms of what comes in interim budget announcements as an allocation towards cold storage, warehouses, so on and so forth, are obviously going to create a huge positive impact and a multiplier effect. The dedicated Western Freight Corridor, as it starts gaining steam, and the kind of warehouses that are coming through along the tracks, and the expectations in terms of a lot of infra growth that is happening across the country. A lot of these warehouses that will get established, you will need this hub and spoke model with national logistic players actually sufficing these requirements to a large extent. With the kind of highways and roads and infra that is getting built, the expectation of 45 kilometers a day, connecting a large part of the hinterland as well, the last mile connectivity as far as tier 2, tier 3 cities are concerned, that is also going to have a huge implication and a positive impact for these logistic players. So yeah, something like a Blue Dart Express, all cargo because of the deal with Gati, I think that's a positive for both of them on what contours of the deal that have surfaced through. So the space looks very, very interesting. I think India is a growing market and logistics should continue.
Mayuresh, what is your view on Hind Copper? The stock has really gathered momentum of late. 5 days, a 20% surge, 1 month, a 42% surge. It's definitely at a 6-month, year-to-date, 1 year, and even a 5-year high as well at 225.4. What kind of a momentum that you see on Hind Copper going forward from here?
The exuberance continues. I think based on 3 factors. One, the expectations in terms of the copper inventory is obviously at an abnormal low level. So as the restocking starts taking place, you're obviously going to have a bump up in terms of the overall volume growth. The second element obviously is how the Chinese demand is expected to come back, because the Chinese demand supply dynamics have a lot of say in terms of how LME prices are determined. And LME prices for both ferrous and non-ferrous metals are at a low level at this juncture as we speak. The expectations as restocking and demand comes back in the second half of the next year will boost copper prices along with other metallic prices as well. And therefore an increase in prices along with stable volume growth and supply coming through should ensure reasonable leverage in the next financial year. The third is obviously, I think, the liquidity part of Hindustan Copper. I'm not really sure, but I think if the liquidity is a little bit on the lower side, and if the free float is on the lower side, you probably get bump up action like you do in terms of the first 2 scenarios playing out. So there are some positives which the market is probably looking at, and therefore the entire expectations in terms of reasonable volume growth with reasonable increase expectations of pricing, assuming in their favor in the next financial year, creating a huge positive implicator effect on the bottom line. So the exuberance of the momentum can very well continue for it.
Okay, exuberance can continue. The other space that's picking up pace is the healthcare pack, the pharma space. Divi's Laboratories is now moving as one of the top movers on the Nifty, almost 2% higher in trade. We also have Dr. Reddy's inching up higher at 56.19, 1.1% higher. Sun Pharma at 0.7% of an uptick. Cipla, 0.6% higher in trade as well. Piramal Enterprises and Piramal Pharma, all of them moving higher in trade as well. Let me take, Mayuresh, your view, and then Kiran can also mark their top stocks as far as the pharma space is concerned. Is it COVID, the comeback of COVID that is like leading to this momentum now?
I hope not. But I think a large extent is how these firms are positioned. Obviously, there was a lot of under ownership a couple of quarters, and the expectation largely is that both valuations and a fair bit of ownership, which is now picking up steam within this space, whether you talk about pharma, in particular within the healthcare space, is something that is providing momentum to the stock. Obviously, something that we continue holding and liking within our global portfolios is Sun Pharma. The company is embarking on the specialty portfolio division quite well, and the progress has been quite reasonably placed. You've got 5 or 6 drugs which are either in stage 2, stage 3, which probably mean that as they clear these stages in the next few months and quarters, the monetization pipeline is readily available for Sun Pharma. The kind of R&D spends that they are doing as a percentage of top line between 7.5% augurs well. And any approvals in terms of FDA for their affected brands is obviously going to create an upside trigger for Sun Pharma as well. So I think monetization of their key specialty pipeline, expectations of stable margin performance, and expectations in terms of delivery as far as new products are concerned, should augur well as far as earnings are concerned. So I think Sun Pharma remains our topic, and as a disclaimer, they remain on our global portfolios.
Okay. Thank Mayuresh for being with us on the show. He has another show to go for. Thanks a lot, Mayuresh, for being with us and sparing all that time. Always a pleasure hosting you on Business Today TV.